I think a lot of this goes back to the Treasury market. I think the volatility that we've seen in Treasuries has rattled part of the equity market. And we've seen that notably in some of the high-flying names, that kind of the Magnificent Seven or whatever you want to call them. And I think that's probably going to be a template for the coming months where Treasury vol will spill over into equity vol. And the fact that we've had a reassessment on the fixed income side about the creditworthiness or relative creditworthiness of Uncle Sam, that adds to that whole dynamic. So I think we've probably got a bit more of that to come. It's probably more a story for us 6 to 9 months out when the earnings come into focus again, the quality of earnings and delivery of earnings. But yeah, I think we can certainly, we can see more volatility feeding through into equities.
Yeah, in the meantime, then, do you see those yields dropping off then in the U.S. consistently? I mean, we had seen the 10-year hit north of 4.3. Does that go down then from here? You reckon 4% maybe? And that spill over, as you said, into the equity space. Is there then a continued bullish run you still see for the end of the year?
In terms of timeline, the kind of choppiness that we expect, we could see that. You could see yields push higher before they start to turn lower. So I think the catalyst there has to be that the Fed and other central banks are convinced that the disinflation story is taking hold. We think there's plenty of evidence of that, but it depends on how the Fed sees that and what their tone and rhetoric is like. That could push yields a little bit higher before they go lower. But for us, the case is in time, looking out 6, 12 months, we should see the market going from inversion to flat to steepening. And that should be a good tailwind for bond investors. But that very turnaround, if that comes around the same time that equity earnings, especially US earnings, where stocks are on pretty high multiples versus European comparisons, that could cause a bit further choppiness. So you could actually have a period 6, 9 months out where bonds do a lot better than equities for a bit.
Des, it makes me wonder whether you're saying that the market has overreacted to Jackson Hole, because the slow motion breakout that we had in those 10-year yields over the course of August seemed to have stalled as we had Jackson Hole and the market was comforted by the messaging from Jay Powell. So was it an overreaction in terms of buying back into stocks on the back of this event?
Quite possibly. I mean, your opening comments was, you normally expect some kind of liquidity issues coming up in August and September. Maybe we've just had those a little bit earlier. We've had an overreaction. I suppose, the fact that Fitch was had a certain degree of circumspection about the ratings of US Treasuries. We've just gone through the debt ceiling. But, before the financial crisis, the US had less than 40% debt to GDP. That's probably heading north of 100%. So that has got to come into the play some stage. I think Jackson Hole was the excuse for that to come onto the table and for bond investors to take a little bit of money back. And I think we can see more of that. We probably will see more of that. The governments have become very indebted in the last few years. The US is running a budget deficit this year of someplace between 5.5% and 6%. And that's bound to raise eyebrows at some point. Absolutely.
Theory around September is that you've had all the good news that comes through from corporate earnings, and all the rest of the news flow will just simply be bad news for the markets. And to your point around the exposure that some Treasury investors have to the US's financing needs. Can I just pick up on one of your calls here for downside protection? Do you think now is the time to take out some insurance on stocks still?
It depends on your horizon, but yeah, I mean, if you're looking at 1-2 years, I think downside protection starts to make sense. For us, just to be clear, I mean, tactically we're overweight equities, but that's very much on a 1, 2, 3 month basis, mainly because the market backdrop, the technicals, some of the fundamentals for equity earnings are solid, but we just don't see that being sustained. So as you go out 6, 12 months, I think some degree of downside protection, or that you look for some quality of earnings, and maybe you can get that, you can get more of a cushion because of lower valuations in Europe and EM, but that we're probably a little bit early on those trades yet. So some protection, whether you look at an offset basket or option strategy or some volatility triggered strategy, we think that makes a lot of sense as you look at 6 months and that kind of time period.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.